Hi, today we're focusing on applied finance using what we've learned so far with principal component analysis and factor models in this unsupervised machine learning series. Don't worry, we'll keep it simple and intuitive, but still practical enough for finance and investing. But if it's your first time in this channel, we suggest that you also backtrack a bit and watch our previous videos to learn the computational side using Excel and our own QuantProf add-in. By the end of this video, you'll understand Number 1, how PCA and factor analysis are used in finance. Number 2, examples of factor analysis and factor models, like the macroeconomic surprise factor model, where macroeconomic surprises like GDP, inflation, and interest rates can drive the modeling of asset returns. And 3, how the term structure of interest rates, explained by a level, slope, and curvature, can be broken down using PCA. This is going to be fun, so let's get started. Imagine you've got hundreds of economic and financial variables: stock returns, bond yields, GDP growth, inflation data, interest rates, etc. It's overwhelming. PCA is like a data simplification tool. Instead of focusing on every single variable, PCA finds hidden patterns that capture most of the variation. Factor analysis in finance builds on this idea. Instead of saying every stock moves on its own, we assume there are common drivers like economic growth, inflation, or monetary policy that explain most movements across variables. And how do we do that? First, we get the data, normally in terms of movements like returns or rates, get the correlation of the data, do a PCA, find the groupings of correlations, then finally find the factors that group variables that explain a big chunk of the variations. Now let's connect this to real finance. In applied finance, one popular model is the macroeconomic factor model. The idea is simple. Asset prices react not just to levels of GDP, inflation, or interest rates, but to surprises. Example, if markets expect 2% GDP growth, but the actual number comes in at 3%, that's a positive surprise. Stocks may rally if inflation prints higher than expected. Bond prices might drop in expectations of higher interest rates. So when we model returns, we often regress them against unexpected changes in GDP, inflation, and interest rates, for example. PCA can help us extract the surprises cleanly, even when variables overlap. So let's do a concrete example. Suppose the market expects the following: GDP growth at 2%, inflation at 2.5%, and interest rate at 3%. But the actual numbers come in as GDP at 3%, inflation at 3%, and interest rates at 3.5%. Therefore, the surprises are GDP surprise 1%, inflation surprise 0.5%, rate surprise 0.5%. Now imagine a stock reacts like this with the coefficients determined by a prior linear regression model. More on this soon. So for every 1% GDP surprise, it gains 2%. For every 1% inflation surprise, it loses 1%. For every 1% interest rate surprise, it loses 0.5%. So expected return will be 1 times 2%, 0.5 times negative 1%, plus 0.5 times negative 0.5%, for a total of 1.25%. So the expected returns, given the surprises, will add 1.25%. That's a simple factor model in action. You're decomposing a stock return into reactions to macroeconomic surprises. So in this case, it's almost gonna be like this for fixed income analysis, where you expect that a bunch of numbers, when put together, will change the price by a certain X%. So the second application is PCA and the yield curve, or the term structure of interest rates. The yield curve is random. PCA shows us that almost all movements can be explained by just 3 factors. For example, Letterman and Schenkman in 1919 is a seminal study that applied principal components analysis to U.S. Treasury yield curve data and demonstrated that the vast majority of yield curve movements can be explained by 3 key factors. These factors correspond intuitively to: number 1, the level represents a parallel shift affecting interest rates across all maturities approximately equally, indicating a change in the overall level of interest rates. Number 2, the slope. It captures changes in the steepness of the yield curve by affecting short-term and long-term rates differently, indicating twists in the curve. Then curvature. Number 3. It explains movements in the middle maturities relative to the short and long ends, capturing the hump-shaped changes in the yield curve. So Litterman and Scheikman found that these three factors explain about 98 to 99% of the variability in the yield curve. They also showed how these factor loadings affect bonds differently based on their maturities, providing a method for hedging yield curve risk by using sensitivities to each factor. The work laid the foundation for why they use three-factor yield curve models and informed risk management and fixed income portfolio strategies by reducing the complex dynamics of the term structure into a few interpretable dimensions. This framework remains highly influential in both academic research and industry practice for modeling bond returns and understanding interest rate risk. And we will talk about this in some future videos. Here's an example. This is the yield curve yesterday versus today for this following maturities, 2 years, 5 years, and 10 years. So the change is 0.20%. Notice all yields went up by the same amount, and that's a level shift or a parallel shift. Now suppose instead that it looks like this, where the 2-year, 5-year, and 10-year rates move by this much with the following changes. Here, short-term yields rose a lot. Long-term yields barely moved, and that's a slope change. The yield curve is flattening. Finally, imagine this. You have the 2-year, 5-year, and 10-year maturities with the following yields, and these are the changes. Here, the middle yields rose more than short and long. That's curvature. The curve bends. And here's the beauty. PCA shows that these three patterns, level, slope, and curvature, explain over 95% of yield curve movements. We will explain this some more when we get to our fixed income analysis series, but for now, we can remember these three factors that explain movements in the term structure of interest rates as part of the financial literature using PCA and factor analysis. So why does this matter in finance? Well, for risk management, instead of tracking 100 different risks, you focus only on a few macro factors. For portfolio construction, you can hedge against inflation shocks or position your portfolio for changes in the slope of the yield curve, etc. And we will have some more videos about this. Forecasting. Factor models help predict how markets might react to economic surprises and also have an estimate of what the changes in the expected returns might be. So, to recap, PCA simplifies complex financial data into a few key factors. Macroeconomic factor models use surprises in GDP, inflation, and rates to explain asset returns and forecast the change in expected returns. The yield curve can be described by just three factors: level, slope, and curvature, and they also help us explain potentially the changes in the rates given a fixed income portfolio. So if you found this breakdown useful, smash that like button, subscribe for more finance explainers, and let me know in the comments your thoughts on the subject matter. See you next time!